Hello and welcome to The Explainer. I am so thrilled you're joining us today because, wow, do we have a truly fascinating financial puzzle to put together. We're looking at the Q2 2026 earnings report from Service Properties Trust, better known by its ticker SVC. Now, if you follow real estate investment trusts, you already know that earnings reports can sometimes be, well, a little dry. But not this one. Absolutely not. This report is a masterclass in corporate restructuring. We're talking massive headline shocks, insanely aggressive balance sheet maneuvers, and a completely radical shift in their core business strategy. So we're going to break down the seemingly chaotic report to give you a clear, structured understanding of exactly what's going on behind the scenes.
Okay, let's dive into this. Negative 4,275%. No, that is not a typo. That is the actual massive earnings miss SVC reported for their second quarter. Wall Street was expecting a minor loss, just 4 cents a share, and SVC delivered a loss of $1.75. I mean, your immediate thought is probably, how in the world can a company possibly survive a miss of that magnitude, right? Is this literally the end of the line? Well, as we're going to see, in the quirky world of real estate accounting, the headline number rarely tells the whole story.
To make sense of all this noise, here is our roadmap. The headline shock, peeling back the numbers, the great portfolio pivot, navigating the dead cliff, Wall Street's divided verdict, and finally, the road ahead.
Let's kick things off with Section 1, the headline shock.
On the surface, this quarter looked like a complete disaster, but there's a really stark contradiction in the numbers. On one hand, you have a clear green flag, a totally solid revenue beat. They brought in nearly $421 million, beating expectations by over 4%. But right next to that top-line win is a glaring red flag, the GAAP earnings per share. Like we mentioned, a projected 4-cent loss completely ballooned into a $1.75 loss. The massive gap between beating revenue and a bottom-line EPS disaster, it strongly suggests something highly unusual happened below the operating level.
Moving right along to Section 2, peeling back the numbers. Now, what's really interesting about this slide is how the accounting metrics completely change the narrative. You have that GAAP net loss of $223.8 million hanging out there. But any seasoned real estate investor knows you don't value REITs on GAAP earnings. You look at normalized funds from operations, or FFO, which adds back depreciation to show the true cash actually being generated. And when you look closely at that, normalized FFO was exactly 43 cents per share. That perfectly matched Wall Street's expectations. So their core cash flow? It's exactly where it was supposed to be.
So where did that massive GAAP loss actually come from? Well, it was driven almost entirely by one specific thing, a $189.1 million non-cash impairment charge. SVC is in the process of selling off a bunch of underperforming hotels, and because the expected sale prices for those properties are lower than the value recorded on their accounting books, they had to take a massive write-down. But remember, this is just a paper loss recognizing past depreciation. It is not actual cash flying out the door this quarter.
That brings us to Section 3, the great portfolio pivot. Historically, SVC was heavily weighted toward hotels. And let's face it, hotels are notoriously volatile. But now, the whole portfolio has shifted. We're looking at 52.1% net lease properties. We're talking travel centers, quick service restaurants, grocery stores, and 47.9% hotels. They are purposefully shrinking their hotel footprint to transform into a predominantly service-focused retail net lease platform. They are pivoting away from volatility and leaning hard into stability.
I absolutely love this quote from CEO Chris Bellato because it perfectly explains the logic behind what is admittedly a painful transition. He says the company is redirecting capital away from assets with structurally negative returns and toward properties already showing a clear trajectory of margin improvement. Basically, they are willingly taking a hit today, cutting their losses on the bad assets so they can fund a much more profitable future.
Let's actually compare what they're cutting versus what they're keeping, because this is a massive green flag for the company's future. The 15 hotels they are dumping, they operated at a negative EBITDA margin. They were literally bleeding cash, causing a $15 million drag on the company. By selling them off, that drag instantly disappears. It is the ultimate definition of addition by subtraction. Meanwhile, the 78 hotels they're actually holding on to boast a 19.4% EBITDA margin, and their revenue for available room outpaced the entire industry with 6.6% growth. They are aggressively keeping the winners and cutting the losers.
Now contrast the hotel side with the absolute rock-solid stability of their net lease portfolio. This is another major green flag we have to talk about. The net lease side is sitting at 96.6% occupancy and saw 2.2% growth in net operating income.
Even better, their biggest tenant, Travel Centers of America, which makes up a huge chunk of their revenue, saw its rent coverage ratio improve to 1.34 times. That just means TA is generating more than enough cash to comfortably pay their rent to SVC. No drama, just reliable income.
On to Section 4, Navigating the Debt Cliff.
Here's the harsh reality. All those operational improvements don't mean a single thing if the company gets crushed by its own balance sheet. And this looming debt maturity wall is the single biggest red flag hanging over SVC right now. They have over $1 billion coming due between 2027 and 2028. The risk was so severe that S&P recently downgraded their credit rating to B-. Financial health metrics were literally flagging SVC as weak because of a massive debt-to-equity ratio. Management had to act incredibly fast or this debt wall was absolutely going to crush them.
To knock down that wall, management executed a highly aggressive and, frankly, a highly painful strategy for current shareholders. Step 1, they issued a staggering 416.7 million new shares at just $1.20 apiece to quickly raise cash. Step 2, to fix the penny stock price that caused, they executed a 1-for-5 reverse stock split. Step 3, they took all that freshly raised cash and immediately paid off $550 million of their 2027 senior notes. Yes, it was massive, brutal equity dilution, but it removed an immediate existential threat to the company.
So the crucial point is this. What did all that painful dilution actually buy them? Well, it bought them survival, and it successfully saved the company $30 million in annual cash interest. By paying down high-interest debt with equity, they freed up $30 million a year in cash flow. It's a tough pill to swallow for sure, but it makes the entire balance sheet significantly safer moving forward.
Let's look at Section 5, Wall Street's divided verdict.
When a company takes such drastic actions, you'd expect strong opinions, and Wall Street is completely polarized right now. We're looking at 2 strong buys, 2 holds, and 1 strong sell. There's this intense, ongoing debate over whether SVC is just a value trap that's going to keep diluting shareholders, or if this is actually the rock bottom of a brilliant turnaround success story. Interestingly, insiders like the RMR Group have expressed real interest in buying shares, which is definitely a green flag. But the wider analyst community, they are totally split.
From a purely technical perspective, the picture is pretty tough. This is a significant red flag for the momentum traders out there. Bar chart shows a 56% sell signal, primarily driven by the fact that the stock is currently trading 13.5% below its 200-day moving average. In fact, it's trading below all of its key short and long-term moving averages right now, which creates a really heavy ceiling of technical resistance. The market is definitely in a show-me phase before it rewards the stock.
Now, a massive reason retail investors are so frustrated stems from severe dividend cuts. In a desperate bid to preserve cash, the dividend fell from 80 cents just a few years ago all the way down to a projected 5 cents per quarter. Now, the silver lining here, a bit of a green flag for REIT purists, is that they've actually managed to maintain at least some dividend for 32 consecutive years to keep their official REIT status, and they are generating positive cash available for distribution. But for the folks who bought in years ago expecting a high yield, this has been a really rough ride.
Finally, let's wrap up with Section 6, the road ahead.
To bring this explainer home, we have to look at what exactly comes next. Management has a very strict operational checklist they have to hit perfectly over the next 12 months to win back the market's trust. First up, they need to close the remaining hotel sales by year-end to finally stop that EBITDA bleed. Second, they have to finish the renovation of the Nautilus Hotel in Miami by November, which will turn a current construction drag into a massive cash generator. And finally, they need to successfully refinance their remaining 2027 zero-coupon notes into standard, regular-way debt. No room for error here.
And that leaves us with this final, provocative question to consider today. Is the immediate, undeniable pain of SVC's radical restructuring, we're talking the equity dilution, the slashed dividends, the massive paper losses, is all of that worth the long-term promise of a cleaner, more profitable, and highly stable net lease portfolio? They are literally shrinking to grow, cutting the rot to save the tree. It's an incredibly bold strategy, and how they execute on these next few steps is going to determine absolutely everything. Thank you so much for joining me on The Explainer today. Keep learning, keep analyzing, and I'll catch you next time.